A tax year is just the 12-month period you use to report income and expenses. Most individuals are calendar year, January 1st through December 31st. Businesses can sometimes use a fiscal year, like ending March 31st, or even a 52/53rds week year that ends on a chosen weekday. And if you start up, shut down, or change years, you may have a short tax year. On the EA exam, partnerships and S corporations are where tax year rules get picky. They generally must use a required tax year, meaning they often can't just pick whatever year-end they want. The default outcome is usually the calendar year, unless there's a rule that forces a different year, or the entity can prove a real business purpose to use a fiscal year. For partnerships, one of the biggest required year rules is the majority interest partner test. If partners who share the same tax year own more than 50% of both capital and profits, the partnership's required tax year is that tax year. Notice the exam trap. It's not 50% or more. It must be more than 50%. Here's the classic fact pattern. Red owns 30% and is calendar year. Blue owns 70% and has a fiscal year ending March 31st. Because Blue owns a majority interest, the partnership must conform to Blue's year-end. So the partnership's tax year ends March 31st. On exam questions, your first move is to identify who's over 50%, then match that year-end. What if the entity wants a different year-end anyway? The key phrase is bona fide business purpose. If a partnership or S corporation can support a legitimate business reason for a fiscal year, it requests approval using Form 1128, application to adopt, change, or retain a tax year. For EA exam purposes, remember, Form 1128 is the tax year change form. Quick wrap-up logic you can apply under time pressure. Start with required tax year. For partnerships, check if a more than 50% group shares the same year. If yes, that year controls. If not, expect calendar year unless a valid business purpose is established. And if you see Form 1128 in an answer choice, think requesting a different year-end. With regards to the Centralized Partnership Audit Regime, or CPAR, which statement is true? Is electing out automatic if the partnership has fewer than 100 partners? Or are only partnerships with more than 100 partners subject to CPAR? Or does CPAR apply unless the partnership makes a valid opt-out election? Or does the IRS exclude small partnerships from CPAR? Think about it. The true statement is that CPAR applies unless the partnership makes a valid opt-out election. The tempting wrong answer is the one implying fewer than 100 partners means you're automatically out. That's not how it works. Being eligible to opt out is different from actually opting out. You have to make the election correctly, or CPAR procedures apply. Future Capital Incorporation. Which business activity would automatically classify the corporation as a personal services corporation, a PSC? The options include education, publishing, engineering, and construction. Think about which one is on the IRS's enumerated list of personal service fields. Engineering is the correct choice. It's one of the enumerated personal service fields, along with areas like accounting, law, health, consulting, and architecture. A tempting wrong answer is education, because it sounds like a service business. But for PSC classification, the exam wants you to recognize the specific listed fields, and engineering is on that list.